First of all, I want to thank Tony and Greg Norton for sponsoring this session. For your, long-term partnership with the Northern California chapter. I actually think this discussion is particularly highlight why we're so unique, because most of the board members in the Valley sit on both public board as well as venture-backed private board, and sometimes, very often, go through that transition. I don't know how many colleagues tells me I got 3 public, 5 private, and then the next day they got 4 public, 2 private. So I think it's very unique looking at Spac, because as investors, we see the relevancy of the liquidity channels that Spac represent. And as public companies, we look at that as, what difference in the governance, the structure, as well as the whole board responsibility. So my background is actually, very unusual for the Valley. I'm a computer scientist by training. I spent 30 years in IBM, which obviously everybody in the Valley thinks that's something wrong with me. But I have since retired, came to the dark side, joined NEA, which is a venture capital firm, at the same time serving several public company board and private company board. What attracted me to Spac was, like, I know many of us on this session, we start getting approached by, different casts, I think, from the traditional search firm of Hedrick and Egon and Stewart, is more of Fidelity, Morgan Stanley, and JP Morgan, considering Spac as a potential board member for the IPO, or considering joining a almost ready for Spac private company. So I started my learning and due diligence, reading a lot of filing of Spacs, and really understanding what is the selection process from the sponsor perspective, the profile they're looking for, what kind of a governance structure, and of course, what kind of a compensation. Is really a tremendous learning. But I have to say, and I know we're going to spend the whole session discussing it, I'm really excited about that. And I know many of you are trying to make the decision of jumping in or holding off, especially with, as Tony talked a little bit about this new SEC, the warrant structure, which the day they announced that, we were actually talking to Lloyd, and he has a whole PhD thesis already on that day for. So we're going to have a lot of knowledge behind that. So for me, it's really about understanding what it means, understanding the risk, and I have to say, it is a very exciting space, and I am almost ready to jump in on both sides of the net, both taking on a Spac investment acquisition corporate board, as well as a company that is about to go through the Spac. But before we go any deeper, as I mentioned, Lloyd really have a really, Spac is not new. It is new to me. I started learning it only when the whole, surge started to happen in 2020. But I really would love, Lloyd, for you to introduce yourself, as I just did quickly. But tell us how we got here. What made it so hot all of a sudden? And, all the aspects that you think this particular audience at this point needs to be aware of. I think I learned so much just by preparing this session. So I would love you to share that with this audience. Please go for it.
Okay, thank you for the intro. Can you hear me well, Claudia?
Yes.
Okay, great. So I've been fortunate enough to been in the Valley for some time, came out of Boston, where I did my first couple of startups in Boston, took 2 companies public. Last one we were bought by a Silicon Valley-based company. So I moved out here. Public company CEO, private company CEO, company called Micromuse years back. We sold it to IBM, one of your companies, Claudia. We did another startup after that, which we sold to Oracle. Last public company I ran was Brocade, which we sold to Broadcom about 2.5 years ago for $6 billion. I serve today, I'm chairman of the board of 2 public companies, kind of a strange spot. But one of them is Nuance, which just this week were bought by Microsoft for $20 billion. So chair of the board of Nuance. I also chair Grid Dynamics, which is a company that I bought via Spac. And I also am on the Visa's audit committee board. I chair the audit committee for Visa, and I am on the board of a company called Vertex. I'm on 4 public company boards. I chair 2 and chair 1 audit committee. So SPACs, I did my first SPAC 2.5 years ago. When I did my first SPAC, or the first one in Silicon Valley, I'd explain to people what a SPAC was. I mean, no VC knew what a SPAC was. They anybody who knew what a SPAC was had a bad connotation of it, because SPACs back in the days were something that especially private equity guys would spin up a SPAC to sell an asset that they couldn't take public, and then they'd leave the shareholders holding the bag while they took off, because they were selling $10 a share, but they were in it at pennies on the dollar. So if it dropped to $5, what do they care? They made money, right? So the SEC actually frowned upon SPACs and put all kinds of guidelines in place that if you create a SPAC, you can't be self-serving. You can't create a SPAC to spin out your own asset, right? You actually should not know what you're about to buy when you start a SPAC. So you come full cycle now, and SPACs are going crazy, right? There were 200 SPACs in January, there were 300 in February, and now there's 400. There were 35 last week trying to de-SPAC. The week before there was 25 trying to de-SPAC. De-SPAC is a process where once you've raised the money and you found a target, then you try to de-SPAC by buying that target. It's an acquisition. So and I should also thank Tony and his team, because Grant Thornton is one of the premier companies out there doing work for SPACs, and they're doing work right now on one of the SPACs that I have. So the one I did, we raised $200 million, and we went out in the year, we found a target, Grid Dynamics. We took it, but we bought it, so now Grid Dynamics is public. I raised it on a SPAC last November. We raised $400 million this time, and we're in the hunt to try and find something to de-SPAC. But in the meantime, the SEC has come knocking, right? Because everyone is seeing the SPACs now as a alternate solution to an IPO. It is quicker to go public with a SPAC, but you have to be ready to be a public company. Yeah, and Tony and his team will tell you, you got to be PCAOB compliant. You have to be ready to be audited. Yeah, to those standards. Otherwise, you're not ready to be bought by a SPAC. And so a lot of people are getting caught short with that. A lot of people are not doing proper due diligence. We have bankers telling me, hey, Lloyd, a guy called me last week. He signed an LOI on Friday, and it's Wednesday. He's calling me to try to de-SPAC. He's done 2 days of diligence, right? And he's trying to de-SPAC the company. So, I mean, the SEC is after it. I mean, the SPACs are exploding. The first shot across the bow was a warrant treatment where, warrants before, we treated warrants as equity, and it didn't hit the P&L. Now they're saying, no. You got to treat it as an asset on the books that'll be on the P&L, and it's going to be an onerous task, because every quarter now you got to mark to market the price of the warrants versus the price of the stock, and you can adjust the P&L accordingly. So now there's, Tony and his team has some work cut out from now, right? So there is the next thing the SEC is coming after is you, the board members, you people who are being asked to join boards. The SPAC guys will tell you that, hey, look, this is no problem. We do all the due diligence. We just want your name, and we give you $250,000. Not so fast, right? You as a director of a public company, which you are when you sign on to be a director of a SPAC, you have responsibility, you have fiduciary responsibility. And if you don't think that, you just look at all the lawsuits being filed now by the ambulance chaser law firms filing against SPACs and the SPAC directors. Look at the D&O insurance rates, which have tripled from when I did mine, right? Because the insurance guys
underwriters.
yeah, underwriters realize the liability, right? So they're tripling the insurance rate. So don't let anyone fool you into thinking, this is an easy way to be a director. No, you have fiscal responsibility. You are responsible for the veracity of the books. You are responsible for the acquisition that's made. And so you have to treat this like a real public company, because it is a real public company. So we're here because people, realize it's quicker to go, and it's quicker. The big distinction is in a SPAC, you can show 3 years of potential earnings, and to your investors and have your multiples tied to your 2022 numbers, your 2023 numbers. In reality, when you go public, regular IPO, you can't do that. Right now, you coach the analysts who follow your stock to say, hey, I think I'm going to do this, wink, wink, wink. You're too low, wink, wink, wink. And there's this kabuki dance you do, right? Whereas in the SPAC, you show up, you say, hey, here it is, right here in my 21, 22, 23 numbers, and I want a multiple based on my 22 numbers, right? And so you can have less verified revenue and get to market with a SPAC. But you have to be every bit as solid a company from understanding the veracity of the revenue streams, the revenue you've logged, your customers, the product. So all that diligence work that you do normally as a public company when you're buying something, you have to do the same thing.
Yeah. That's such an important point. I mean, my due diligence has really leaned me towards how many of out there SPACs that are just this ad hoc composition of people that literally come to you and say, why not? Right, here's $250,000. We just need to borrow your name for a couple of months. As a matter of fact, Lloyd said, don't pick up the phone unless it's $1 million. So that there's a criteria for all of you. And then you really don't have any kind of influence and control on what is going on after that, right? You want to have really the due diligence influence to see what is being bought. Otherwise, you might walk away with money, but your reputation is pretty toast. So, Irad, you obviously have been guiding companies through the traditional IPO process, including, of course, Tesla. And I know, all the venture firms are looking at SPAC as a way of liquidity. So it will be really good for you to talk about for so many of the board members here that also sit on venture-backed company board, in terms of how you view SPAC and the opportunities that you see and the potential risks that you think we need to be aware of. And introduce yourself, by the way.
Okay. Well, first of all, it is great to be here. Just a terrific group of people. Thanks for convening us to talk about this timely topic. And as I always say, I usually like to say it behind her back, but one of my absolute favorite people on the planet, both personally and professionally, happens to be Claudia. So I always say I show up wherever she is. So a pleasure from that standpoint, as always. So this is my about 25th year as a venture capitalist. I founded and am the managing partner of a firm called DBL Partners, which stands for Double Bottom Line. DBL is one of the pioneering firms in impact investing. The moniker didn't exist when DBL was founded, and my partners and I started investing with that thesis that you could be uncompromising investing for both a top financial return as well as a social or environmental return. And we viewed it, the traditional view was that was mutually exclusive. We viewed it quite the opposite, as mutually reinforcing. And so we've raised a little over $1 billion of capital on this thesis, invested in energy, food ag, aerospace, a number of the traditional sectors of IT. But we also focus on social dimensions and diversity and a number of other initiatives. And as Claudia referenced, the early investor in Tesla, and I've been on that board now basically since we were an early private company. Chair 2 of our 3 board committees, both Nom, Gov, and Com. So, part of what's happened here with the SPAC explosion, comes back, at least from a venture perspective, with this massive growth of late stage financing. And in many ways, SPACs are filling this gap between this late stage financing capital and growth capital on the one side and the traditional IPO process on the other side. And what we've seen, the backdrop of the last few years, is there's been this catalyst of unicorn financings. There's over 600 private unicorns today. There's been over 100, about 120 newly minted unicorns each of the last 3 years. And it's been against the backdrop, particularly more recently and during COVID, of more and more private companies that have been delaying IPO plans. They've been shelving or delaying, notwithstanding continued growth on the private side. And then you have an increasing number of companies that have raised massive capital that have reached unicorn status, but haven't had the financials that have caught up with their valuation. And so it's against this backdrop that we see a lot of the SPAC interest from a private company perspective. And as you said, we spend a lot of our time in boardrooms and in our partnership, recognizing that although SPACs have 4 letters, we often wrestle with whether or not SPACs are actually a 4-letter word. And like anything else, there's some real pros and cons. Lloyd, I think, did a really nice job talking about some of them. But one of the dimensions from a private board member and entrepreneur perspective is, one dimension of it is the certainty. It removes the uncertainty of IPO roadshows and banker negotiations and chasing that elusive IPO window. Instead, we have price and valuation fixed through a negotiation with the IPO sponsor. We can somewhat control a little easier the de-SPAC timing. So certainty is clearly important. Lloyd references, well, speed. It can be a more expeditious route to the public markets, and you can raise capital on a shorter timeline. But I just caveat that is case to case. And there's instances that we've seen where just because of the prep and how ready the underlying company is, it can actually take quite a longer period of time than was initially forecast. You heard a bit about this projection issue, which stems back to these earlier stage companies that could never have given projections to on a year, given a traditional IPO set of regulations. And in fact, the way it would be valued wouldn't be within a short-term window. It would have to be discounted back from what people believe over that longer horizon. And that's opened the door for so many companies that could never have gone out with a traditional IPO process. And then, relative to this late stage growth financing, the question relative to valuation is it less dilutive? And in many cases, it has been less dilutive. So that's a lot of the reasons you've seen interest. The flip side, and as we try and evaluate whether or not it's a fit for many of our companies, costs were often described potentially as they can actually be more expensive compared to an IPO. And the final economics aren't known until the transaction is complete. But when you factor in fees and sponsor dilution and the pipe discounts, traditionally, I think either Tony or Lloyd mentioned SPACs were a negative signal. And I think we're still in this zone where the public market investors are trying to figure out, is it still a negative signal? And we're beginning to see a bifurcation of quality companies, as one would expect, but it definitely is getting the scrutiny of a number of the public market investors. And the regulatory uncertainty, as we've seen just this last week, is an overhang. And then the two, I think, most important cautionary tales to going down this path. One is, a lot of people view this as a get rich quick. We view it as a get rich slow approach. Number one, the lockup period is typically longer in this process. So you really have to be, at least for the existing investors and management, so you really have to be in this for the longer haul for at least a part of the overall ecosystem. And then perhaps the most important thing that we spend our time on is this issue of misalignment. And the idea that the sponsors can actually do quite well, even though the underlying long-term shareholders, team, and new investors may not. And so this trend we've seen recently to at least a smaller subset of SPAC sponsors doing a zero warrant structure, I think has some mitigating elements to that issue. But I think it's going to be an increasingly important way in which the highest quality companies decide their SPAC sponsors.
I don't know, Lloyd, you have anything to add?
No, I think he's right in the misalignment. And I think one of the ways people are also trying to correct for the misalignment is not just the zero warrants, but also with the promote. The sponsors and their shares they get can range from 20 to 25%.
Right.
That's why, as he stated, it can actually be more expensive to go the SPAC route. Right. And so you're seeing people trading off promote in some instances to get deals done, or it's not unusual now. Half the deals that were done in the past month, the promote was staggered. So the $10 is the strike price for the SPAC. You see promotes where 25% is vesting at $15. I've seen high as $25 a share, right? So you're seeing that that's forcing the alignment with the promote guys. It can't be a get rich quick scheme. One of the side effects, though, of so many SPACs out there, I mean, there's over 400 right now, chasing too few good companies. There aren't 400 good companies to buy, right? And so some of these SPACs will fail, and you'll see that bifurcation of the ones that are good SPACs and bad SPACs. The get rich quick guys will fail, but they've also impacted, the certainty issue, right? Certainty was one of the calling cards of the SPAC, because you could say to a CEO, hey, look, you got to raise late stage capital. You can go to the PE guys who are going to rip you off, and you're not going to get any. You've been there 7-10 years. You want to get into cash for your employees, whatever. And so you get the PE route, or you can go the route of the IPO. But to his point, there's unpredictability of the IPOs, right? For the last couple of years, unless you're a unicorn, you couldn't get priority being scheduled to go out, right? There was always a reason why you weren't prioritized to go out. There is certainty in the timing of the SPAC, but what was also true for the SPACs, a year ago, was certainty on the exit, because you had a smaller group of investors that, as a SPAC sponsor, that you curated, and then they would pretty much do what you told them to do because they trusted you. Half the SPACs last week that were trying to go de-SPAC failed. They had to pull back. Of the ones that were successful, half of those had to change their valuation downwards, because what's happening is there's too few SPAC, there are too many SPACs chasing too few deals, so they're driving up the valuations. And when they go back to de-SPAC, what was a certainty, because I have 20 key investors that gave me $400 million. I tell them, here's what I'm buying, and they say, okay, you made money for me in the first SPAC, you made money for me at Brocade, and so on and so forth. They trust me. But you have these guys that have shown up, they've never done a SPAC before, have no track record, and they're coming with these companies, these huge valuations, and the market's saying not so fast. The valuation doesn't make sense. So they've actually taken away one of the strong points of the SPAC, the certainty issue, because now the street is saying, wait a minute, half the SPACs are trading down, and they're saying, wait a minute, this doesn't make sense.
Yeah.
I will just say, from a capital markets perspective, just on a more holistic level, it is great that we're actually in a time when we're actually creating more optionality. SPACs are, of course, the discussion today, but we just saw Coinbase through direct listing last week. This is actually a very important trend as to how we're going to actually continue the journey around capital formation in the public markets, where it's not just that narrow lens that we've had for the past several decades. And this trend around finding newer and perhaps different ways to be public is something that's not going to change. That is going to continue, and the SEC is going to have to navigate clearly the risk dimension to any of these options. But it is an important thing that these younger companies find a route to access the public markets in different and more creative ways than previous.
You're right. I mean, SPACs have been around for over 20 years. They'll be here 20 years from now, right? I think we've got a bubble right now, and it's frothy, and the SEC is rightfully trying to rein it in. And for the good sponsors, the good teams, the people who are in it for the long haul, as you described, it's best for them that some of these SPACs get weeded out, because some of these are really get-rich quick schemes out there that need to be weeded out.
And Lloyd, I not only agree with what you're saying, but the fact that the capital markets are Darwinian is a truism, and that's true both at the earliest stage venture side that we play in, and it's true all the way through the public markets. And the fact is that not all companies are going to win, and the pressures and the history around the Darwinian process unfolding actually is an important signal.
Well, the difference here, Ira, is, as a VC firm, if your investment does not perform, you have a hard time raising your next fund. So the problem is on the SPAC, if they don't perform, or the asset they acquired do not perform, is uncorrelated with their ability to raise funds, because they already did that one-time deal. So just bring that conversation back to the selection as a potential board member on a SPAC board when you're being asked by a sponsor or a company that are looking to go through the SPAC for IPO. I actually think there's so much. I shared the excitement part of it. I think there are a value creation opportunity here. As a venture capitalist investor, you always look at these passionate entrepreneur, and some of them are just having such a hard time with the liquidity, particularly in the industries that may have, and IRA the expert on that, a broader, longer term impact like the environment and ESG and all the things that we're seeing. So what we're seeing with the SPAC is some of these ESG, energy transition, the healthcare, cannabis, I don't know if you can call that. So we're seeing obviously a true, alternative liquidity path that is very positive. And the way I look at it is, the duty of due care, due loyalty is the same for SPAC. And obviously the level of disclosure is something that you need to be very aware of. Structure are very different. Obviously, there's no operational aspect of the company. You really need to understand the sponsor behind. I think Lloyd made a very strong point on that. Is there a reputable, credible, well-established team that has a deep industry expertise, and they're going to be in this for a long term? They have M&A capabilities that they can do a wholesome due diligence. Or literally, I have SPACs that approach me saying, well, we already have a target, which they're not supposed to. This will be just a couple of months, borrow your name, and then, you can go. It's like, oh, wow, that's pretty exciting. It's fast moving, it's dynamic. But then what happened to your reputation if you care? So I do see reputation as a director as one of the major consideration with SPAC. Even though, the SEC is pulling in and trying to change some of these alignment of, get rich fast and not being accountable for the outcome, I do think you need to think very seriously about, do you have, any kind of a direct control over this process and the governance, and not allowing yourself to get attracted to this very, very easy, E&L type of scheme that people are trying to sell you. I look for, SPACs that I know the institution behind it. I know the sponsor behind it. They've been together for a long time. They have done other deal, either as a private equity or venture investor. They have, acquisition talents on board. They have industry depth that they are tapping into on the target base that they're looking to be SPAC. So all those are clear ingredient, of course, all comes down to people. For me, the selection process on the SPAC has evolved, obviously, as Lloyd said. Before it was like, oh my God, this is so, get rich fast, and there's all these to choose from. And now is a much more, deeper due diligence, because you need to know the liabilities that you take on. And as Lloyd said, all the lawsuits that has already initiated. So I want to, this is from my experience from looking at all these different filing of the SPAC and the ones that I'm exposed to. I want to get Lloyd's recommendation for us, for this group of directors, in terms of the level of due diligence we need to do in selecting. I mean, when do we pick up the phone? Aside for that $1 million thing that you told me about, Lloyd, that which I haven't been offered yet. What are the criteria that you think we all should be aware of, as well as, what is the profile? I know this deep M&A, experience is part of a deep industry. They like public company board because like you said, most of these assets have no idea what public company governance look like. So what are the key criteria you think we all need to keep in mind as we look at the potential board members are available to us?
So I'll key on something Ira said and he talks about his fund and how they're long-term focused. And kudos for sticking with Tesla, by the way. That's a really good call.
He haven't sold a share, Lloyd. He have not sold a single share. He is like, Stanford MBA, Harvard JD, and he's the car salesman of the valley.
Yeah. Good job on that one, Ira. So it's no different than for me, if you're asked to go on a traditional public company board, because you're going to a public company board. The first thing you do, if I called you, Claude, and said, I want you to join my board that I'm a part of, you'd say, I want to talk to the CEO. I want to talk to the primary person, get a sense of who that person is, what their style is like, because I'm going to be in a working relationship with this person. I think you should do the same thing with the SPAC. And you want to do, again, to Ira's point of, you want someone who's in for the long term. I would not look to acquire a company as part of my SPAC. And my investors wouldn't either. I mean, the people who gave me 200 million and 400 million, the first question they ask them when I come back with a company is, so what's your role going to be, Lloyd? They want to know that I'm in it, right? They want to know that I'm going to be chairman of the board. I'm going to be helping to grow the company. I'm going to help the company attain whatever the 2022 and 2023 numbers we're saying we're going to do, right? And so I think you should do the same thing as a board member. You should be looking at this company and saying, this is something you want to be engaged with for a long time. Now, a lot of the SPACs, what happens is you de-SPAC, and very few of the SPAC directors get carried over to the new company, to the newly formed company. Well, you should think of it as if you could be and will be carried on to the new company. So you really think about long term. Are my engagement something I'd want to be involved in for the next 5 years? And again, talk to the executives that are there and get a sense that they are in it for the long term. Because if they're not in for the long term, they're going to cut corners. It's like anybody running a company. If you know that you have to, be around for 5 years, the decisions you make around R&D, around marketing spending, about all the alternative spending you can do, that is way different than if you know you're only going to be in it for a year. It's just human nature. There's no way you're going to convince me that you think about it the same way 1 year to 5 years. There's no way. And so you're going to get a sense of what they're doing. I saw a question flash up there about director independence. And you really have to think about it, that the sponsors, that there has to be a firewall between the sponsors and the director.
Yeah. Sometimes
the sponsors are directors. But you have these SPACs now that are doing 5, 6 SPACs, multiple SPACs. They have legal teams spun up, audit teams spun up, diligence teams spun up. And you have to ensure that what you're being charged for, because they're charging for it, by the way, each SPAC is being charged, that you're getting the value for it. I mean, in my SPAC, and I didn't do the first one through, maybe the first one in Silicon Valley, so I learned some things there. Second one through, I have a second engagement letter with the auditors. I have a second engagement letter with the lawyers. I mean, we did our own diligence last time, and we're doing our own diligence now. So we don't depend on the SPAC sponsors to just say, hey, here is the deal, sign off and, move over. We really look at it as, again, no different if I was at Brocade buying a company, what would we do? We treat it the same way.
Right. I mean, S1 filing was what, a few hundred pages, and you need to really do your due diligence there because it really show, the depth of the competence. Ira, do you have anything to add on how to select your board amongst the SPACs?
Well, look, I actually not only agree, being on a public board, a traditional public board versus being on a SPAC board with the expectation of a roll-off on de-SPAC is not only a different animal, it's not just apples and oranges, it's like apples and scissors. It's a totally different beast here. Being on a public board, the way Lloyd and I think about being involved, and you, Claudia, for your entire career, think about being involved with companies is we get involved. I always say it's the difference between being a builder versus being a banker. We're trying to get inside the company and really be a partner to help grow the company. And, you referenced one of our companies, but in all of our companies, we are long-term partners helping the company achieve its strategic objectives, not over, a quarter-to-quarter basis, but in our case, and in most, and when people think about going on public boards, over the very long haul. The SPAC board context is actually one of executing a short-term, one-time transaction. And so in many ways, these are boards that function much more like an M&A team.
Mhm.
They're trying to identify a target. They're trying to structure a deal. They're trying to deliver favorable economics to stakeholders over a relatively short cycle of the SPAC, de-SPAC, and the exit post-lockup. And as you said, there's many of these target board members who are going on to the SPAC boards, often for reputational name or other purposes, but without a mindset of this is going to be a company that I'm going to be part of for many years and help guide and be part of a strategic direction and organizational build long haul. And so it's just a really different, when we talk about whether or not either we or friends or others go on these SPAC boards, the question is, are you being asked in the context of a traditional board member recruit,
Right.
or are you asking, or are people asking to be part of the M&A team?
Yeah, but I think they tend to approach you with this short-term get rich fast approach, right? We like your M&A experience, we like your industry expertise. This will not tie you up as your normal public board, which some of my board, the retirement age is 75, so I'm in it for the long haul here. But I think the conviction rate needs to be the same. All right. You need to really believe on the team the same way you believe when you invest in a startup company.
You're 100% right. That is the way it should be. I'm just describing the way it has unfolded in so many of these SPAC cases, where the rationale for SPAC board member recruit, and in fact, the way in which a lot of the SPAC board members are going on is different than the way you're describing what it should be and the way Lloyd and I operate. There are a lot of, unfortunately, a lot of examples of this shorter term horizon. And look, at the end of the day, part of this is, even with the best of M&A skills, in many of these cases, these are shotgun weddings. Yeah. This is not due diligence done over a long haul. In many cases, these are shotgun weddings. And so, as to your point, the risk as a fiduciary in a shotgun wedding like this is just different than what a long haul investor and someone who's done serious diligence around a company in both the private and ultimately public markets do.
Yeah.
And so Ira is dead on. There is what we think it should be, being good long-term investors, and what the reality has evolved. Mm-hmm. And it's exactly why the SEC is all excited, right? Because the SEC is looking out for the investor. They don't care about the promote people or the SPAC sponsors or the board members. They're looking out for the investors and saying, this short-term mentality is not to the benefit of the investors. And that's where, yes, even though there is a curated group of investors that hand me all this money, once we are a public company, mom and pop can buy a share, right? The lawyer down the street, the guy, driving the Uber can buy a share. So anybody can, I can't stop you from buying shares, right? And so the SEC rolls in and say, wait a minute, this short-termism is exactly why we had problems with SPACs 10 years ago, and exactly why we tried to curtail them 10 years ago. I mean, I know VC firms are trying to create their own SPACs. And I'm like, well, you realize the one of the base tenets is you can't self-serve, right? You can't create a SPAC to go take one of your portfolio companies public. You know that, right? And they kind of wave their hands, oh, no, we've got a way to do this. It's like, we have a way to do this. It's not legal. But they're all thinking about, how do we get a piece of the action, right? So there is this reality that Ira describes is exactly why the SEC is so perturbed. And a lot of people are getting, left by the wayside like they did 10 years ago. They're buying assets, realizing that the revenue isn't real, realizing that technology isn't real, all based on the fact that proper due diligence wasn't done. And if your job is a SPAC sponsor to churn SPACs and get a deal done within 2 years, otherwise, poof, everything goes away. Your motivation is not how do I get the best deal for the shareholder, it's how do I get the best deal for the sponsor. Yeah. And that is the problem. And that's the problem that the SEC is trying to solve for.
That is, I mean, the bottom line is due diligence, right? This is not a, fly by the night, shotgun wedding. This is actually a lot more serious due diligence required. for you to really want to engage as a board member? I mean, aside from, investigating on the team and all the capabilities, also, ask what kind of influence do you have on the M&A process? Are you going to be part of the due diligence to identify the target and go for the combination process, or are you just going to be the sort of sitting on the side? They only want one meeting from you, which actually was a selling point for one of the Spacs that approached me. I only need to have one meeting when they just about to go. It's like, wait a minute, you can be buying, a pizzeria, and and my expertise is completely irrelevant. So I will be very aware of that. Well, I know Haley is saying it's now 2:20 almost. Do we have questions, Tony, or do we
do. Yeah, we've got some really great questions actually. So I'll start off with one that kind of follows on to what you guys have been discussing here, and that's how do you define hitting the nail on the head in terms of creating a really good SPAC? So otherwise you referred to kind of 50% of SPACs being successful. What does that look like?
Well, I mean, for me, you want to, when you de-SPAC, and a lot of SPACs now are raising pipes, right? So I raised $400 million from investors. I buy a company that's worth $2.5 billion. They want to have some extra cash in the books, so you're going to raise a pipe for like $200-300 million a pipe. You're going to make sure that when you raise the pipe, that this trades up, right? That when you go out to the marketplace, the thing doesn't. So you want to make sure that when you present to your investors this opportunity, and you compare the company you're buying, that you've done due diligence on, that there is a delta to how their peers trade in the marketplace. So 20% delta would be great, right? But mostly 10% is kind of a good enough number. But you want to have a delta that says, here's a company XYZ I'm buying, Mr. Investors, my 20 investors, and what I'm paying for it is 10% less than what their peers trade in the public market. So they get in the game, and it trades up the day after. Like with any IPO, the worst thing about an IPO is it trades down after it goes out, right? And it's the same thing with the SPAC. You want to make sure that you build momentum. So from a financial standpoint, you want to make sure that there's enough of a delta, and then it trades up. Now, and within the next year, that you make your numbers every quarter, right? That the numbers are real, that you make what you exceed what you say you're going to do, and every quarter, at the end of the year, you did more than you said you're going to do. And so at the end, it's a financial transaction, right? So the hitting nail on the head is having the stock price grow faster than their peers.
I'll just add, look, it is true that ultimately the stock price rising, we view as a result of a successful outcome, a successful transaction, but it really comes down to having a team that's ready with predictability of forecast and a predictability of business model. And when that happens, you are able to achieve a stock price result. But one of the reasons that I think a lot of the fundamental investors really have a jaded eye is because most of the great public investors are not actually trying to arbitrage over the short term. They're trying to invest in great companies over the long haul. And so one of the successful dimensions to building out a transaction in the space, like an IPO, would be to get long-term shareholders and identifying a shareholder base that is going to believe in a story, believe in a team, be part of a long-term journey, as opposed to having massive shareholder turnover, is a really important dimension to making this a successful outcome. Again, not over days, weeks, months, quarters, but over the much longer horizon. And there's the good news is we've talked about the pitfalls. We've talked about a number of companies that are going through this process that probably shouldn't be and don't deserve to be, and SPAC sponsors the same. But let's also make sure we're also highlighting there are companies out there at the other end that actually do fit the profile of deserving to be public. There being a number of reasons why this is a better path, and having a set of dimensions that would make a traditional IPO successful. They're mirroring through this process as well.
I echo that. And one of the things too is, I mean, grid. I mean, we're up 40%. So, I mean, so there's a classic case there, but it all echoes back to, if I could put in a nutshell, what Ira just said, you have to be ready to go public. So you have to have predictable revenue, you got to have a strong management team, strong execution team, strong product, all the boxes you check when you're going public as a regular IPO process. This again is an alternative to that. You got to check those boxes. And then if any of those boxes don't check, then you're not ready to go.
Yeah.
And one of the points that some of the investors, by the way, some of the long-term guys, because he's right, you want to make sure you have a portfolio of investors you've curated who are more long-term than short-term, because a bunch of short-term guys for over the years, always in the SPAC space, right? They churn these SPACs. But some of the big guys like Fidelity's and Putnam's, they won't go into my SPAC until I come back with a company. They won't give me the $400 million or the $200 million. When I come back and say I'm buying company XYZ, I'll get money from Fidelity because they've always given me money. So, but they are not, their bylaws preclude them from investing in SPACs. They cannot. You have, until you tell them what you're buying, they can't invest.
And I mean, the good news about Darwin is, you know, there are companies that are the fittest, and there are companies that actually are attracting the Fidelities, the T Rows, and the core group of long-term shareholder base that you would want as a company that would go through a traditional alternative. So it's not just because you're going through SPAC that you don't have the opportunity to do that. It's just that you got to make sure that you've got the underlying profile to make that happen.
Yeah, I will even say that is one of the criteria, right? Who are the advisors to the SPAC? You know, are these, you know, reputable, you know, people with long-term investors, or somebody you never heard of? I certainly use that as one of my criteria. You know, you get people coming at you and you want to know who they are, what have they done, and the fact that they were brought in by a JP Morgan or Morgan Stanley or Fidelity give you a level of confidence to even start the conversation.
Yeah, which all goes back to that concept of being ready, right? Are you ready to be a public company? No doubt about it.
Right, the same guys.
That's right. And so we've got a number of questions on related specifically to board, but there's one that came through a little bit ago, and I want to make sure we get to this. And I knew this one was coming, and that relates to the warrants. So can you guys walk us through the mechanism of the warrants? And this may be one for you, Lloyd. And the different options there, such as zero warrants, and obviously,
zero warrants are kind of new to the game. Trying to solve, because the warrants are dilutive, right? What happens is, if you're coming at $10 a share, and for every share you buy, warrants are set at either 50, half a warrant, a third a warrant, a quarter warrant. So if it's set at half a warrant, you buy one share, you have the right to buy at a price set, usually say $11.50 or $12. At $12, you can buy, half a share, right? So if you bought 100 shares, you get warrants to buy 50 shares at a strike price of say $12. So the stock, so you're never going to execute that. You know, if the stock's trading below 12 bucks, the stock's trading at $18, then you're gonna exercise your right to buy at 12. The company actually gets money. They get $12, times the 50, so they get $600, and you, the investor, you now have upside on the share. So warrants, again, you come in at 10 bucks, you buy 100 shares. If it's 50% warrants, you get to buy 50 shares, and it's at a strike price. And before, what would happen is we would treat those just as equity, as if we're issuing shares to insiders. SEC has come back and says, no, you have to treat that as actual, a liability in your balance sheet. So you've got to figure out how many warrants you have, and you're going to treat that as a liability in your balance sheet. So now it moves over from equity onto the P&L, and so it's an impact on the P&L. So it's a little more onerous, and to Ira's point, I think you're going to see a lot more people issue less warrants. My first deal, it was 50% warrants. The second deal now is a third warrant. And you're going to see people issuing fewer warrants because it really is a pain in the derriere for people like you. Tony, we have to deal with, quarterly, mark to market, what's the price of the warrant, strike price versus what the stock's trading for. And you also see more people, you have the ability to buy out the warrants at you also set it up so you can buy out the warrants and clean them up. Maybe at $18, you have the right to buy out the warrants, something like that. So there's always, so you'll see more people move to do that sooner rather than later. Because there is that warrant overhang.
Yeah, and creates a lot more volatility in earnings and the like as
Yep.
well.
Yeah.
All right, a couple, just shifting gears a little bit here. We have a couple of questions related to the boards themselves. And the first one is there an ideal or typical common size for SPAC boards?
Sorry, Tony, can you just repeat that?
Oh, sure. I'm sorry. Is there a typical or ideal size for SPAC boards? So, is there a number of board members that's more common?
Well, I think 5 to 8, I don't know what you think, usually is a smaller than a public company board. Usually is half from the sponsor and half independent. So I have seen structurally. I don't know, what have you seen, Lloyd?
Mine are both in 5. I keep them at 5 because they're manageable. You can get meetings quickly and so on. Yeah.
All right.
I just say, typically when you ask the question, Tony, you ask about the SPAC board, often when you read about these transactions, it conflates the SPAC board with the underlying resultant de-SPAC board. Right. And I just think every time we talk about it, it's really important to make sure that that we are not conflating, confusing, or talking about those as the same. Yeah. And so what we've been answering is the period of time when the SPAC has, prior to actually selecting and de-SPACing. That's the 5 number that Lloyd's referring to. And ultimately, the size and composition of the resultant board would typically be a combination of the SPAC board and the target board.
Yeah,
and then often be higher than 5.
Yeah, and the target usually retain a higher level of equity than the sponsors of SPAC. So they tend to have more board seats where they get the control in electing. Average SPAC has, probably 10-15% equity position after, and that will give them maybe 1 seat or 2, or maybe none. So I will say in a good de-SPAC, you will see the companies to maintain a lot of control over their board more than the sponsors, the SPAC sponsor.
Yeah. So kind of staying on the board theme. Looking back, are there questions you wish you had asked before entering into a relationship with a SPAC?
For the first one through, we didn't have the right SPAC composition. We had, I was late to that one, and the board members were stacked pretty much ex-CEO types. My second one, the board composition is stacked towards the D-SPAC, having experts to help on the diligence, legal experts, comp experts, because there's always comp issues, right? And if it's an IPO or it's a SPAC, on that process of that merger, having to figure out 409 issues for the employees, making sure compensation is aligned with the public companies versus what they're getting in the private company space. And so as arduous as the accounting component of it is, being PCAOB compliant, ensuring that the compensation is also aligned is important. So my second one, I was dialed in for D-SPAC. All the compensation issues I had, accounting issues I had. So I had, people on my board who were comp experts. I had people on my board who were experts on technology, helping me do the technical due diligence. So it was really aimed at what do I need for a D-SPAC team?
Yeah. I think, the question I will ask is why me? Right? What exactly is the expertise or competency that you're seeking on me as an individual independent director, even as part of the SPAC? If they can articulate well what value you bring to the process of the SPAC, then I think you'll be very alarmed that this is just a quick E&L, they just want to throw a few good names out there. And your reputation as a public company director is a very high value, asset that you have. So you have to protect that.
Yeah. So do you see that when you look at the recruiting process for the DSPAC board, right? Do you see that as any different than recruiting for any other public company out there?
I think from seller perspective, I don't see, Lloyd, go ahead.
No, I think, with all these boards, you want to be sure that, do you want to be associated with the worst case scenario with a company that went out and the stock price failed, it's trading, below its offering price because technology wasn't real, management wasn't capable, revenue wasn't real, or some restatement. All of those things are possible, and you really need to think about either that interim board that Ira described so well of, before your DSPAC or the post-SPAC board. You need to be careful. You need to think about your reputation. Do you want to be a part of that headline? What's a headline you want to be a part of, right? Because the SPAC can fail. There's, as much as they try to sell it as, there's no way you can fail. No, they're failing right now. Just go look at the numbers, right? And so do you want to be associated with that? And what can you do to ensure that you're associated with the inverse, with a company that the stock price went up, it's stable in the marketplace, has good products, revenue is real, good technology, so on and so forth. So it is a different board that you want DSPAC because you really are in that SPAC space trying to get a transaction done, right? That's the thing you're trying to get done. And you want to make sure that when you go DSPAC, it's a longer term game, and so you need different expertise there.
Yeah, and beware of the selling point that if they don't find a good target, they will just give the money back, right? I mean, just recognize the incentive structure is more likely they will make a bad deal than they will give the money back. And
to that point, Claudia, it matters where in that 2-year journey they are. If you're at the tail end of that, the likelihood of bad decision goes up. But Tony, I look at the recruiting for the DSPAC board exactly the same way. And just as a private company board member, we're trying to find public company fellow board members to chair audit, to chair nom-gov, to be part of that long-term public company journey. And when we think about this as in terms of building the underlying target companies that may ultimately go through a SPAC, we're looking at it through the exact same lens as who's going to be part of that journey.
Claudia, you were joking when you said it.
Sorry, Lloyd, go ahead.
I'm saying just Claudia's point about a bad deal. When I was doing this 2.5 years ago, the first time, I had SPAC guys tell me point blank, Lloyd, a bad deal is better than no deal.
Yeah.
Point blank, a bad deal is better than no deal.
Yeah. And I'll just say on the board recruiting side, just like great companies actually have a lot of choice. In fact, the great companies right now that are going down the SPAC process are getting their choice of which SPAC sponsor to partner with. But the same is true, of course, on the director side. Great directors have choice. And the fact that a company is go through a SPAC and they'll be part of a DSPAC company is no different than the lens by which any great director, if someone's going to ask Claudia to be on their board, they're competing with a lot of other companies that want Claudia to be on their board. And the fact that they're going through a SPAC process isn't going to somehow lower the bar in any way. It may actually heighten the bar for someone like Claudia to join.
I think it's a very exciting, way to obtain liquidity to some of these companies that really are, they're just because they're in industries that does not draw as much capital as, software, AI. But the maturity of the companies that are, out there are very few, and there are just too many people chasing them.
Typically, when we're recruiting board members, it is harder to recruit long-term board members until they actually know what the de-SPAC company is. And so in recruiting for the SPAC board, you're doing it without having the visibility around the target.
Right.
And so typically, there's a lot of board members out there that actually will ultimately want to know what's the long-term board I'm going to be on, to the extent that they're being targeted for being that one or potentially two on the de-SPAC board.
Yeah, that's why the earlier question, the question to ask is, how much of an influence am I participating on the due diligence, right, of the combination, merger, whatever you want to call it, the de-SPAC process? If they say, oh, no, we need minimum, it's not a good sign.
Yeah, so we've got a couple of minutes left here, and I've got a couple of remaining questions that I think we can get to. Both of them, so they relate to governance and D&O. So the first one on D&O is, as a director, how much is enough? And any guidelines or frameworks you guys might recommend? You know
what they say about D&O in the public board, right? You just get the best for the cheapest price. If there's such a thing as this, they don't. And of course, I think Lloyd already touched. There's actually a very limited, coverage, especially now with the lawsuit and all that. My sense is, you just gotta lean on a broker that has a great reputation, that does a lot of benchmarking against other SPAC. I mean, I think lean, because it's so new and so fluid at this point. I will really make sure that the recommendation come from a very reputable and experienced broker. Somebody like Tony. There you go.
This is a much broader conversation on D&O, but D&O costs have skyrocketed for a whole bunch of reasons, not the least of which the ambulatory chasing reference earlier, but there's a number of other reasons why D&O costs have skyrocketed. But remember that the right answer to the question depends on a whole host of factors around the underlying entity. And we're just inevitably talking about a different operating and organizational structure in a SPAC board versus a company that is the ultimate target board. And but as Lloyd points out, there's becoming such increasing risk and scrutiny on the SPAC board that's not a statement that you don't need sufficient coverage. It is a statement that it's different in a SPAC board than it would be if you were a part of a $100 billion company or a $200 billion market cap company with massive operations.
Yeah. No, and that sort of ties right into, I think, this next question here, and that is related to governance. And we'll make this our last one as we're starting to wrap up. But obviously, governance is a huge need on the long-term de-SPAC board, right? So the question really is surrounding how much, how important is that director governance role on the SPAC board, given that it's short-term in terms of managing risk.
I think go ahead.
Just quick. I mean, I have the luxury of having been one of the first ones out there, and the SEC actually poking at me to ask me questions about how we did it, what we did, and why, and so on. And so a good sense of where they're heading, because they've told me where they're heading, right? And the first volley again was this warrant thing, but to Ira's point of the shotgun wedding board composition, they don't like that. They think it doesn't serve the long-term investors very well, and they're trying to figure out how to solve for that problem. And one of the things that they're really coming down on, based on the questions they've been asking me, and they've told us outright, some of us, is the whole issue of director independence. Are the directors really working on the behalf of the people who gave them the money, mm-hmm. or are they work on behalf of the sponsors?
Mm-hmm.
And in their mind, they're unequivocal. You should be working on the public shareholders' behalf and solely on their behalf. And to the extent to which you can prove that you're doing that, prove your independence, you're going to be in good stead with the SEC. The extent to which it's murky and there are gray lines between what you do for the sponsor and what they do for you and how they compensate you, you're going to be in trouble with the SEC going forward.
Yeah.
That is the path that they're on.
The good news is, although it is mission critical compared to other types of committees that one would do on a typical board, and one really does need to understand the governance dimensions to being on a SPAC board, the good news is it's actually a much narrower range of governance issues that one has to wrestle with, understand, get their arms around, and have the right kinds of guidance and expertise, compared to a DSPAC board where the governance would just have, you know, an exponential number of issues that one would face on a SPAC board you wouldn't.
Yeah, and I think, you know, the other type is the companies that are looking at DSPAC as a potential liquidity event. And for those type of board consideration, you do need to understand they're asking you because all the governance skills that you have, and that is a very positive sign, because recognizing that they will need all that in order to be a public company, as Lloyd was indicating earlier, is a very good, solid, you know, company, rather than this is just a financing round, and we're not really concerned about the governance aspect of it.
It is clear not all of these are spectacular.
Well, look, this has been fantastic, and I just want to thank everyone who participated today, especially Claudia, Ira, and Lloyd. Your insights have been, I know, invaluable to the audience. It's really been a privilege to be able to spend time with all of you today.